So in our view, the underperformance of emerging market equities is a secular trend that's been underway for about 5 years. The markets have now derated and are trading at a 26% discount to the rest of the world. However, we feel unfortunately that there may be further underperformance to come. The reason being that this is a genuine deterioration in profits in these markets, and that may have further to run. Our fear really is that there's an increase in the cost of capital for these companies, such as increased wages over the last few years. And as such, the region probably needs to trade down to a larger discount, such as 50%, as it has done so in previous episodes. So while the markets are getting inexpensive, the derating probably has further to run. Within emerging markets, we have a preference for North Asian markets and emerging Europe, where we feel valuations are more extreme. We continue to remain underweight Latin America. As I noted earlier, we have a preference for markets in North Asia, China, Taiwan, Korea and Japan. We see valuations as being more extreme in these markets, and fundamentals such as growth and profits are modestly better than the peer group. Elsewhere in the world, we're overweight European equities with a preference for Italy and Austria. Europe has already experienced a crisis and appears to be making a bottom, with trends in growth and profits starting to improve, albeit from a low base. The credit transmission mechanism in Europe now seems to be working, and monetary policy remains extremely accommodative. Within the US, we have a modest underweight. That country has outperformed largely due to superior profits. However, it now looks modestly expensive relative to other markets, hence we're underweight. And then finally, Latin America. Despite the poor fundamentals, the region still trades at a valuation premium to the rest of the world, and hence we're maximum underweight. Global inflation pressures and expectations remain fairly low. Therefore, we do not anticipate an aggressive monetary normalization cycle in the US. Indeed, policy is more likely to be eased elsewhere in the world, causing bond yields to remain well behaved at low levels. Within fixed income, we have a modest preference for the US high yield market, where we still see some value. Despite the episode in the energy sector, which makes up 17% of that market, high yield bonds are only slightly down year to date and have recovered quite well from the August panic. Overall risk compensation in the high yield market is still around 500 basis points or 5% in yield terms, so slightly above average, and therefore we do see some value in that segment of the market. So over the medium term, the earnings yield on equities relative to the yield available on bonds does suggest that equities should deliver superior returns of the order of 6% in real terms compared to bonds. So we would still have a preference for equities over bonds in multi-asset portfolios.